You buy a house, place a tenant inside, and collect rent. On the surface, real estate investing looks like a straightforward path to passive income. The beginner math usually goes like this. Your tenant pays $2,000 a month in rent, your mortgage is $1,200, so you pocket $800 in pure profit. Relying on that simple calculation is exactly why so many first-time investors find themselves writing a personal check every month to keep their property afloat. This waterfall chart shows what actually happens to that $2,000 gross rent. Long before the bank gets its mortgage payment, your cash is steadily drained by property taxes, insurance, maintenance, and inevitable vacancies. Quickly, your cash flow drops below the zero line. Assuming gross rent minus the mortgage equals your profit is the fastest way to bankrupt a real estate business. To protect investors from that exact spreadsheet optimism, the real estate industry relies on a specific heuristic, the 50% rule. This graphic shows the rule's strict definition. Your operating expenses should consume about half of your operating income. It's a foundational criteria used by professional investors and analysis software to rapidly evaluate properties on the open market. This block diagram illustrates the premise in action. We take a single block representing your total gross rent, and we split it perfectly in half. One side vanishes to cover your operating expenses. Inside that expense half, you are paying for the predictable costs of running the building. Property taxes, insurance premiums, routine maintenance like fixing a broken garbage disposal, and the fees you pay a property manager. The remaining half of the block is your net operating income, or NOI. This is the actual pool of money you have left over to pay your lender and keep his profit. The question we have to answer is whether this 50% calculation is a mathematical law that guarantees a safe investment, or a crude guessing game that leaves money on the table. To see where the rule falls short, we have to look at what it leaves out. This split-screen matrix compares the 50% operating expenses against the massive financial obligations it entirely ignores. The left side safely captures the everyday, predictable costs of keeping the property functional and legally compliant, like your taxes and management fees. But the right side holds two heavy financial burdens: debt service, your mortgage principal and interest, and capital expenditures, or CapEx. The cost of your mortgage cannot be bundled into a universal percentage. Debt service varies drastically depending on how much cash you put down and the current interest rate environment. Because of this debt service trap, a property can easily pass the 50% rule on paper, looking like a great deal, but still bleed cash every month once your specific mortgage payment clears the bank. Then there is the reality of vacancy. Properties are rarely 100% occupied year-round. Tenants move out, and units sit empty while you secure a replacement. To run the math properly, you have to deduct a 5 to 15% vacancy rate from your gross rent first, and only apply the 50% expense cut to the money you actually expect to collect. Relying exclusively on the 50% rule creates dangerous false positives. It tricks investors into buying negative cash flow properties by masking the true cost of their debt and lost rent. There is also the physical reality of owning an aging building. Over time, major structural components will inevitably fail. These massive, infrequent replacement costs, like tearing off an old roof, fixing a cracked foundation, or installing a new HVAC system, are capital expenditures. CapEx is entirely different from routine maintenance. Fixing a leaky faucet is a minor repair covered by your 50% operating expenses. Ripping out and replacing the home's entire plumbing system is not. If you group CapEx into your standard operating expenses, your long-term reserve accounts will be completely empty when a major system finally breaks. The industry standard solution is to set aside an additional 5 to 10% of your gross rent specifically for capital expenditures. This is a separate reserve fund, completely disconnected from the 50% rule calculations. Treating the 50% rule as an all-inclusive expense budget leaves you exposed to catastrophic out-of-pocket losses the moment a property shows its age. The 50% rule was designed for a very specific type of asset: average condition, long-term residential rentals. Applying this exact math to short-term rentals like Airbnbs causes massive forecasting errors. Short-term rentals carry unique operational costs. You pay for frequent cleanings, restocking supplies, heavy wear and tear on furniture, and high turnover. Those line items easily push your actual expense ratio far above 50%. The same applies to distressed or century-old properties. The aging infrastructure and heavy deferred maintenance required to keep them habitable can drive operating expenses to 65 or 70%. On the other end of the spectrum, brand new construction builds often feature pristine systems and active builder warranties, which can drop your actual operating expenses down to 35% for the first few years. The 50% rule operates entirely on the assumption of average conditions. Applying it to extreme edge cases guarantees inaccurate financial projections. To analyze properties without wasting time, investors use a 3-tier funnel graphic. At the wide top tier, the market screen, you use the 50% rule to rapidly evaluate 100 listings, immediately discarding any property that fails this basic paper test. The surviving properties move into the middle tier, the deep dive. Here, you transition to line item underwriting. You call for actual landlord insurance quotes, verify county tax records, and secure firm property management bids. At the narrow bottom tier, you apply your exact CapEx reserves and your precise debt service costs to those final contenders. This identifies the single asset that actually produces positive cash flow. This funnel method maximizes your speed in the open market without sacrificing the rigorous accuracy required to finalize a purchase. If you are a beginner investor, treat the 50% rule as a mandatory protective shield against your own optimism, rather than a precise calculator. Set a hard boundary. If a property fails the 50% rule plus your mortgage cost, throw the deal out. Never try to justify a bad purchase by assuming you can magically manage the property cheaper than the market average. If you have more experience and want to add value, use the 50% rule as a baseline to spot market inefficiencies. If you find a poorly managed duplex running at 70% expenses, you have an opportunity to buy it, optimize the operations back down to 50%, and increase the property's value. Regardless of your experience level, you must manually verify property taxes, insurance, CapEx, and debt service before you ever sign a purchase agreement. The 50% rule is the ultimate tool for finding the haystack, but rigorous line item underwriting is the only way to safely extract the needle.